Let's get in. Market voice, Ajay Argal, SVP and Senior Portfolio Manager at Franklin Templeton Johnson, right now on the show to talk about his thoughts around markets, economy, and more. Ajay, good having you. Thanks for taking the time out. The views are split right down the middle, Ajay, in terms of whether this is a value zone for India because earnings might look up, or is that because the earnings delivery has been soft and the future is uncertain, we are well valued? Where is it that you are bending towards?
Yeah, good morning, Neeraj. We think that the markets are fairly valued. If you look at in terms of the large caps, look at the Nifty valuations, which are kind of 10% above the last 10-year medians or averages. But if you look at the mid caps and the small caps, they are definitely on the higher side. So mid cap is closer to 29 times, and which is about 35% premium to the large caps, and also premium to its own history and somewhat similar situation for the small caps that they are actually trading at a premium of about 20-25% to the larger caps. Normally, they trade at a discount. So in terms of the earnings delivery, the March quarter, the earnings have been quite up to the mark in the sense that they have met the expectations. But they, as we know, the expectations itself was very low in terms of single digits earnings growth. But generally, they have met the earnings expectations. So now we are looking forward to FY26, and the earnings growth is generally now in the about 11, 12, 13%, that ballpark, which has been a downgrade of about 3% in the last 6 months or so. And of course, we are looking forward to some of the positive triggers which are lined up.
What would those be, Ajay, according to you? And therefore, do they help in taking the earnings growth higher from the 11 to 13% band?
Yeah, I mean, that is what we need to see. So right now, that is what the market thinks in its wisdom, the analyst community and all of us think in our wisdom that that is what the current scenario is. That obviously builds in the triggers which I was talking about. So primary among them is the tax cut, which has already started flowing in from April. So that's about $10 billion stimulus for the consumers, and that is specifically for the middle class, because that kind of tax bracket is where the maximum benefit would come on the consumption side. And then already we have seen 50 basis points of interest rate cuts, and maybe another 50 basis points of interest rate cuts at least is going to happen in this financial year. So that also might have another $5-6 billion of savings for the consumers, which will again be for the middle class. So we are looking at somewhere around $15 billion of extra money in the hands of the consumers, which should actually give a fillip to the urban consumption, because as we know, in the last couple of quarters, the urban consumptions have slowed down, whereas the rural consumption, which has been quite tepid for many quarters, have actually started looking up in the last couple of quarters. So we are looking forward to the urban consumption picking up. And if at all, once that demand picks up, whether there will be more pickup in the capex side from the private corporate sector.
Ajay, hi, good morning. Just wondering, apart from the consumption bit, now this is the sticky bit. When people have more money in their pockets, what are they spending on? Are they spending on, soaps, toothpaste, etc.? Are you looking at core staples? Are they spending on more discretionary items? And would be interested in knowing what your view is. For example, is an Eternal looking more exciting to you, or a Colgate Palmolive?
Yeah, so that's a very good question, and good morning. We think that this saving which is going to come is going to go more towards the consumer discretionary items. So definitely the items where the consumption had reduced when there was some stress for the consumers, and they were typically your food delivery, quick service restaurants, or maybe to some extent automobiles, white goods, refrigerators, washing machines, ACs, etc. So those are the kind of pockets which we think is going to benefit more. And the reason we think that way is because, as I said, the tax benefits as well as the interest rate cut benefits is likely to accrue more to the middle class. So if we leave aside maybe the bottom 10-15% of the consumers which have very low income. The people who have slightly higher income and they are paying income tax, so they will get the benefit in terms of lower tax outgoes and therefore higher savings. And it is quite likely that they would make their expenditure toward those areas. And that's why in our portfolios, we are more geared towards consumer discretionary in terms of the food services, quick commerce, QSR. So some of the names which you mentioned. So yes, we are positioned for that rather than the consumer staples, because consumer staples we have been seeing for quite a long time that the volume growth itself has been tepid, and even now it is single digit volume growth, mid single digit volume growth, and in some companies not even that. And we don't see any signs of that picking up, because you need to keep in mind that the consumer staples, the penetration levels are also much higher. So there is not that much of a benefit if there is increased savings.
So, Ajay, let me take that a step further. When I say discretionary consumption, hotels, airlines, those sectors, tourism, trade, is that something that you think has a further up move now baked in already? Or are you finding interesting pockets of possibilities there?
Yeah, so as usual, it's a bit of everything. So part of it is definitely baked in. So we have seen some of these sectors already done very well. But some of them, there is a bit of a structural story as well. So if you look at the airlines in India, it's going to be a very structural, secular theme, because more and more people are going to fly rather than go by train. So that's a structural thing. And of course, as we all know, there are supply constraints, and for various reasons, the supply constraints were very severe in the last few quarters. That might ease down a bit. But going forward, also, the supply is not going to come to the extent that the demand is going to pick up in the airline side. In the hotels, somewhat similar situation. Supply constraint is there. The demand is strong. But in our opinion, there the expectations are even higher. So we are playing more through the airlines as far as the focus fund is concerned, but in some of our other funds, we are also playing through the hotels sector.
Okay, so what would be your top favorites here, if you could name any names?
So unfortunately, I can't name any names, but as you
Okay.
can see in the portfolio, I mean, we are overweight in the, of course, the financial sector.
Yeah.
We are overweight consumer discretionary, as I already highlighted. We are overweight in the telecom services, and we are overweight in the healthcare, or basically the pharmaceutical sector.
Autos then, I mean, I just want to know what the view on autos is, because there's a lot of geopolitical elements also which are having impact, clarity or lack of clarity on tariffs for some of those players, components coming in, new entrants. How are you seeing that space?
Yeah, so auto, the ones which are domestically oriented, they are not that much impacted with all these developments on the geopolitical front. But there they have their own challenges in terms of the volume growth itself coming down this year. For most of the sectors, the volume growth will be single digits, or maybe mid single digits and lower for passenger cars, for two-wheelers. That's what the expectations are. And also, most of these stocks have done very well, so the expectations are on the higher side in terms of higher valuations. But when you look at the autos, OEMs, as well as the components which are geared more towards exports, so they have these challenges which you highlight. And the primary challenge there is the companies don't know what to do, because the policies are changing all the time, at least as far as the talks are concerned. So right now, a company cannot take a decision of, let's say, starting a manufacturing plant in the US with just a 3-year view, because that's going to be the view for this administration, but we don't know what is going to be the view after that. So the companies typically would look at 15, 20 years before making any significant capex. And also, it's not easy. I mean, capex is one thing, and getting the workers and at that requisite cost so that you are able to make decent ROEs and ROCs. that's a bit of a challenge, and that's why we have seen that a lot of companies in the auto and the auto component space, specifically catering to the export markets and even there more to the US market, they are themselves not giving any guidance or any outlook because they are themselves not sure how things are going to pan out because something is announced and then it is put in abeyance for 90 days. So very difficult to make the decision making there. And therefore, from a stock perspective, also, we are generally on the sidelines. And that is also because of the valuation concerns, which I talked about, that the valuations, the entry point is not really very cheap. So we are focused more on the domestic auto companies.
Got it. Ajay, just one last question very quickly. What's the view on tech, IT services? The reports are chalk and cheese. Are you bullish? Are you not? And why?
So in the focus fund, we are underweight, and we have been
You are
underweight
underweight, okay.
for quite some time. And of course, the stocks have done very well in the last 1.5 months. That I think is just a kind of a sector rotation trade because there was lack of ideas in terms of the lower valuation stocks. But if you look in terms of the outlook for this year, anyway, we know that the growth is going to be very, very low, maybe definitely less than 5%. But even going forward, it's going to be quite a difficult scenario because one, the market share gain for the Indian ID sector is kind of coming to an end because they have very large market share in the areas in which they cater to. And secondly, there is still the phenomena of AI, which people need to understand in terms of what is going to be the impact on the Indian ID companies. So on the one side, there is going to be negative impact in terms of some of the legacy business will go away. But on the other hand, there will be positive impact in terms of some of the new businesses coming in. But as we have seen in the previous cycles, that there might be a mismatch in timing of this, as in the legacy business might be lost first, and then the new businesses tend to come up a bit later. So there might be a few quarters here and there. So from that perspective, also we are not so positive for any growth to pick up even in FY27. And now that the valuations are also run up, we are comfortable with maintaining the underweight position which we have in the sector.
Okay. Ajay, we'll leave it at that. Thanks much for taking the time out and being with us. Really appreciate your time. Well,
Thanks, Neeraj.